that has transpired in the market, and what are we watching out for, for the next trading session and, of course, the RBI meet that is underway. So all eyes are on Reserve Bank of India this week, which is widely expected to hold rates steady. A Reuters poll shows nearly 3 out of 4 economists see no change, though a few still pencil in a 25 bips rate cut. The consensus now is that any easing will come only in early 2026. My colleague Varun Arora is now joining us with what can we expect.
Yes, on RBI policy preview, Reuters poll indicates RBI is likely to maintain its policy rate at its October review. About 74% of economists expect no change as compared to the 77% in the previous survey. Expectation of rate cut have been shifted to the next year of 2026 Q1, as though a small section of economics still expects 25 basis points of rate cut in October. According to Novama, while weak demand, steep tariff and benign inflation argue for rate cut, however, it expects the RBI to hold rates steady in the upcoming policy, as the GST rate cut could be offset by the slower government spending amid weaker tax collection and higher tariffs.
All right, let's decode how the Monetary Policy Committee outcome will be. Will there be a rate cut or will there be a pause? There is a divided house as far as economists are concerned, and we have with us Upasna Bhardwaj as well as Mitali Nikore to decode the same. We also have with us Radhika Rao. Welcome guests, and my first question to you will be Upasna. Do you think this time RBI will pause, or you think this is the apt time to go for 25 basis point rate cut?
Hi, we are looking for a pause right now in October. Basically, see, this is a very close call, I would say. In fact, that one is the primary reason why we had expected that there's not going to be any more rate cuts, at least in the foreseeable future, was that inflation was looking very high from fourth quarter onwards and the subsequent full year of FY27, and significantly higher than probably even 4.5%. That very indicator has come down. Because of GST, whatever the extent of pass-through that happens in inflation, the inflation trajectory has come down significantly, and we are looking not just at this year's inflation being very comfortable, but even FY27 inflation is looking to be anchoring around 4.1% for the time being. What that really means is that it does leave room open for RBI to soften its stance and try and focus on growth. Having said that, I think there should be some powder dry, so RBI can wait and watch and see how the GST impact on the festive-related spending, how all of this is going to play out, how the tariff-related uncertainties are going to play out in due course, and probably from December policy or February policy, we see room for rate cuts, which probably could be to the tune of about 25 to 50 basis additionally. Also, just to mention, real policy rates are very high. So there is absolute room for rate cuts, given that growth is below potential. Only it's about a matter of time. And I think at this point, they should wait and watch for how overall growth indicators pan out in the next 2 months or so.
All right, point taken, Upasna. Let me get in Radhika Rao as well. Radhika, do you think that the RBI has enough room to cut rates in October, given the benign inflation, but a persistent decrease or weakness in the rupee?
Certainly, I think this is one of those meetings that's going to be quite a close call. We are in the camp of expecting the RBI to actually, pause at this meeting. Certainly, there are conditions for which they, especially if you talk about growth. So growth has been quite strong, wasn't quite strong in the first quarter. We think the second quarter growth could also be 7% plus. At the same time, inflation is benign, but gradually heading higher. Especially because of base effects. And the third thing that they're looking at is what is happening to the currency at this point, because GST optimism seems to be knocking on to what's happening from the external catalyst, global catalyst particularly. The rupee has been weakening as a result. Now, based on this macroeconomic environment, I would think that the central bank would wait at this meeting, but consider cutting at the next, because by then they will have more points to work on in terms of what kind of impact has there been because of tariffs. And of course, we've also seen announcements on pharma, announcements on H1B visas in the past couple of weeks. So all of this would give, when it starts skipping into the data, I think it will give them a better idea, and hence they could go ahead and cut rates at the next review. At this review, we expect them to pause and also keep the stance unchanged. And certainly the language will be very important, and I think that's where which will make a big difference, is that they will come out sounding quite dovish, assuring the markets that if there are any downside risks, they would go ahead and cut rates as and when required.
Mitali, I want to know your view as well with the kind of GST announcement which has been made. Do you think RBI will still wait and watch, or you think that at least 25 basis point can be cut this time?
I'm not in the camp of the wait and watch. I do think that in this particular round, we might as well see some rate moderation. I think 25 basis points is expected from my end, and there's actually a logic to that. So we've basically been seeing that the government is using consumption expenditures as a way to buoy the overall sentiment in the economy. When we look at the external markets and we look at the external sector, we know that IT stocks are taking a plunge. We know that there's a worsening external sentiment. We also can see that FDI and FII pullouts are taking place. However, at the same time, the domestic investors now need to step in, and the domestic consumption needs to step in order to sort of bridge that gap which the external sector is leaving. We also have been speaking to a number of traders, and we're finding that the volume of exports is taking a sharp hit in light of the tariffs that have been introduced by the US. So in this situation, in some sectors, of course. So in this situation, it becomes critical for, the investors to feel like the cost of borrowing and the cost of investing in large projects is going to start coming down, and that can only happen with a rate cut. At the same time, even for consumers, a rate cut signals more money for expenditure, and given that the inflation has remained actually quite constant, we haven't seen as much of an upturn in the inflation rates. We feel that there's actually room for the RBI to go ahead and cut rates even at this point in time, sort of to buoy and give that additional sort of impetus over the GST cuts.
Right. Radhika, also, with the CPI expected to edge up in the coming months, how restrictive do you see the current real rates?
So at this point, real rates have a sufficient buffer because we are still seeing a sub 3% inflation and rates are still quite high. So from that point of view, certainly real rates as of now are not in restrictive territory. Certainly gives them a bit more room to act if required. But, as central banks do, and as the RBI had mentioned in the past, that they're looking at a forward-looking trajectory, which basically takes inflation higher, upwards of 4% in about 6-8 months. Now, that being the case, that's given the forward-looking view, the real rates will compress then, perhaps more than what they would like it to be. Their range is somewhere in 1%, 1.5%. If that's the view, then they would look at real rates being restrictive further down the line. But at this point, of course, one of the things that has played into a disinflationary story is what has happened on the indirect taxes. So GST has been rationalized and lowered as a result, and that will put a disinflationary impact, between for the second half of fiscal 26 and fiscal 27 in terms of inflation. So that could allay some kind of near-term concerns that inflation will be a problem. But certainly at this point, it's not at restrictive levels. And hence this thing about a close call, because if they choose to say that, hey, GST has brought down, imparted this disinflationary impulse on inflation, then certainly there is no need to worry about it further down the line. And then thereafter, so it does create the preconditions to go ahead and cut rates. we do think that they are likely to sound dovish, but they will just be on standby to see it in the data first before going ahead to cut rates.
All right, point taken. Upasna, I want to come to you. You would have seen the numbers of IIP at 4% in the last month. How do you think it will shape the policy decision with this kind of IIP data?
You know, IIP tends to be extremely volatile while it's an important real indicator. But, you know, one or two readings in itself may not necessarily explain the entire ambit of, activity that is happening on ground. We know that corporate earnings data is giving us a reasonably grim picture. And I think that's where we need to, link all these aspects and put together. Even though real GDP number for the first quarter came in at 7.8%, and as Radhika said, even the second quarter is looking north of 7%. I think somewhere we need to realize that the nominal GDP growth in single digits is a worrisome situation. Now, if this was to sustain, and especially in a disinflationary environment, this probably is going to be the story for the next couple of quarters more. Now, that is something which we need to address. And hence, I think looking at one or two indicators, which is holding up well, may not really paint the right picture overall.
Okay, Radhika, so how much weight will RBI place on the global central bank moves, particularly the Fed, in timing its cuts going ahead?
So as central bank has maintained in the past, what Fed does or what global central banks do does play into their overall playbook. Many of the preconditions or conditions that they look at when they're assessing the economic situation. But I don't think as a single factor it would influence the timing of their rate cuts, for instance. So if the Fed were to cut rates, I don't think they would necessarily need to mirror it. So I think it would be given weightage, but it won't be one of the primary ones. I think the primary ones would still be domestic considerations. Inflation, growth, and financial stability. I think those are the factors that will really matter and rank high when they're taking a decision on policy rates.
Mitali, while GST implementation has been done, the rate rationalization is a reality now. Do you think the inflationary impact will also be in consideration while the Reserve Bank of India will be deciding on the rate? And how much do you think the spike will be?
So at this point in time, definitely, of course, inflation is one of the major factors which RBI considers when taking a policy rate decision. But at this point in time, given that we've seen that the inflation has remained very well within the bands that have been set by the RBI monetary policy, we've seen that retail inflation has remained below 6%. We can even see that wholesale inflation has actually not crossed the 6% mark. And I think for wholesale inflation, it's a very important decision that has to be taken, because at the end of the day, wholesale inflation is like a leading indicator for retail inflation. Today, if I see that my wholesale inflation is inching up, then tomorrow I know that my retail inflation will also cross certain barriers that I may not be comfortable with. But wholesale inflation itself has been in control. It has been within acceptable limits. And as a result, obviously, that provides RBI with the room that it needs for a rate cut if it should choose to go for it. Of course, I'm not saying that the rate cut should be very high or that it will be very high, because at the end of the day, we have to keep some room to buoy up the economy in the future if global trends become even more negative. But at this point in time, given the global cues and given the fact that India's economy faces exceedingly high amount of pressure, unprecedented amount of pressure from external factors, it becomes very critical for the domestic economy to be, charged up. And also at this point in time, the domestic economic sentiment, especially the consumption sentiment, is at an all-time high, because when we are looking at the GST cuts, these GST cuts have been clearly passed on to consumers in a very branded manner, in a way that they were not done before. So earlier, if there was a rate cut or if there was a GST rate cut, you would not see this kind of a GST utsav, or Bachat utsav kind of discussion that was taking place. But now, if you even visit some of the stores, especially FMCGs or consumer goods, there's a clear branding that is associated with this GST Bachat Utsav, and that is being passed on to consumers quite clearly in a very visible way. And that's creating more of a consumer sentiment to go ahead and consume in this festive period. So I do think that in that line, it makes sense for the RBI to then support, with a small rate cut.
Taking a leaf from that, Upasna, let me come to you. Could these steep tariffs and perhaps potentially slower government spend really offset, the festive season demand that's coming in because of the GST cut?
Yeah, absolutely. I think, we should not forget the kind of risks that we are sitting with respect to the goods tariff related issues, along with the spillover of that to the services segment as well. There is a whole amount of uncertainty. So while GST does have a potential to boost growth by, about 0.6 to 0.7%, but clearly there is more, shock that could come about because of this persistence of tariffs that we're talking about. We have to be clear that there is no immediate overnight, shift or diversification that can happen for India's exporters away from the US to the rest of the world. So clearly there is a challenge that we are sitting with, and we need to address that much more closely, watch that much more closely. So we are very skeptical on that part, and hence, the second half of the year, we do remain very skeptical, and we believe that the second half of the year could be much more softer despite the fiscal stimulus that has come about and despite the GST cuts that we're talking about. I think it is this entire trade-related issues which will be dominating, and hence there will be a softer GDP number in the second half of the year compared to the H1 that we're talking about.
All right, I want to ask actually all of you, what will be the Reserve Bank of India's trajectory? While there is a divided house currently that whether or not Reserve Bank of India will go for rate cut, at least in this policy, but at least expectation is there in the later part of the year, there is going to be rate cut. So let me start with you, Radhika. In 2026, do you expect Reserve Bank of India to move quickly on rate cuts, or will it be more of a slow step by step easing kind of a cycle?
We do think that, they've already undertaken cuts. I don't see them embarking on a very strong, another leg of rate cut cycle. When we talk about the Fed previously, what we think is that the Fed is going to do about 100 basis points now. So basically one already done, 2 more to go this year, and 1 in 2026. For the RBI, I think they've already cut bulk of the moves are already behind us. So at best, we might get it. So in our baseline, we don't have any more forecast for rate cuts, but the risk we see is there could be 25 to 50, depending on how growth goes. And I think that would be the bigger catalyst for the central bank. But I don't really see them embarking on a very aggressive rate cut cycle. At this point, I think the baton has been passed to fiscal policy. The government has done direct, indirect tax changes. They are looking at providing some support to exporters, especially if they're impacted by goods tariffs, for instance. So that is where the shift has happened from monetary policy support to fiscal levers. And hence our view that there's unlikely to be aggressive rate cuts here on. If anything, there's going to be a very shallow part, last leg of the easing.
All right, closing comments from you, Upasna and Mitali, both of you. Upasna, I'll come to you first. What would be the rate cut path for the RBI come 2026, or dot plot, if you will, and then I'll come for the same to Mitali as well.
Yeah, I would broadly concur with Radhika. I think 25 to 50 basis it is, and I think by the end of our financial year we'll be done with. We have 3 policies, including the October one, wherein we expect a pause. If growth continues to be a challenge, then I do expect up to 50 basis of rate cut. But I guess it will happen, and it will continue to be on a prolonged pause post that. I don't really see more aggressive rate cuts beyond that.
Mitali, on the same question, I'll come to you. Although regulator does not give a dot plot kind of a scenario which is there in US Federal Reserve. But considering the fact that you are saying that 25 basis point is what is expected this time, do you think there is more scope?
So that's actually a very important question. I think the timing is a very important consideration for the RBI. I do think that there is no scope beyond 50 basis points. And I think that will be split between 25 basis points now and then seeing the reaction of the growth in this quarter and then in the next quarter. And possibly we will see the next 25 basis points happening in March. And, the next 2 quarters should be able to tide us through to get us to a target growth rate of between 7 to 7.5% for this FY, for FY26. Because at the end of the day, when we are looking at the, overall projected growth rates, the government's target is to definitely end up somewhere close to 6.5 to 7% for the entire FY growth rate. If we look at the inflation trajectory, then clearly we are sitting between 3 to 4%. So definitely the market has the tolerance for a clear 25 basis rate cut now. And that should ease some of, and at least incentivize some of the domestic investors to go ahead and make those investments, especially the private sector. I've been speaking to a number of industry associations, and many of them are sitting on some amount of uninvested cash. And I think with the rate cuts, they would feel the incentive to go ahead and make some investments into expanding capacity.
All right. Thank you, Mitali, Upasna and Radhika, all three of you for joining us and weighing in on the MPC meet. We are largely expecting the rates to remain steady, but some of the participants also believe that there could be perhaps be a possibility of a 25 basis rate cut.